For beginners, options are fairly complex, but selling options is a simple way to earn income, and I'm going to teach you just the simplicities of put option contracts. So when you sell a put, you are predicting that a stock is going to remain above a set price that you choose, and this set price is the strike price. Now the time frame for this prediction is the time frame of the option, and the option will have a time that it has expired, and this is when you win your prediction. Put options give you cash up front for this prediction in the form of a premium, and these predictions can relatively be low risk and still yield substantial amounts, especially if you only write put options on very financially stable companies. Now, to understand options, the first thing you need to understand is that they are a derivative of the stock. So this means that the stock's current price, the stock's volatility, and the time that the option has until expiration all affects the value of the option, because an option contract is a piece of paper that has value, just like a stock has value. I can make a 10% return up front from selling a put option, and the stock would need to drop more than 30% for me to be at a loss. And I do this by a few set of rules. So the first rule is having a 20% cushion. Now, a 20% cushion is having a strike price 20% below the current trading price. So in this way, I'm making a prediction that the stock would have to drop more than 20% for me to lose money. Let's use the example of a stock currently trading at $18. A 20% cushion of this is $14.40, so I'm going to look for an option that has around a 14.40 cent strike. I found one, and I sell one put option contract at a $15 strike for expiration on January of 2018. So I am predicting up until January of 2018 that the stock is going to remain above $15. And if it does, I receive a $1.50 premium per share. Now I sold one contract, which is 100 shares, so in return I receive $150. Now this $150 is mine no matter what. And the only way for me to lose money is if the stock goes much more below the strike price. Now this is my second rule, a 10% annual net return. A $1.50 premium is 10% of the $15 strike. So in this way, I am earning a 10% return by putting up $1,500 of liability. And I have $1,500 of liability if the contract is exercised, which means I have to purchase the shares. I would have to purchase 100 shares at $15, which is $1,500. So why would I do this? Why not just put $1,500 in 100 shares? Well, for me to earn a 10% return on a $1,500 investment, the stock would need to rise by 10%. And this has a low chance of happening if you want to invest in a very financially stable company. So this is why writing puts can be highly profitable, because you already plan for yourself to earn 10% as long as you go by this set of rules. There are two situations that can happen. One is that you predicted correctly and the stock maintained its price above $15. In return, you receive $150, and that's your money permanently. The second situation that happens is that you predicted it to be wrong and the stock dropped below $15. Now, in this situation, the contract is exercised and you have to purchase 100 shares of the stock at $15. But because we received a $1.50 premium, we are only spending $1,350 of our own dollars to buy these 100 shares. And this is the win-win situation for me. Either I get the $150 in cash, or I own a stock at $13.50, which was just trading at $18. And now I only write put options on companies that I would be willing to own long term. Because if I get a stock at a cheap price like $13.50, well, it can go up from that. So writing put options is really beneficial, just because if you write put options on a very stable company with low volatility, there's very low chance for you to actually pay your liability forward. And this can happen, in situations where the stock seriously underperforms or the market is in a sell-off. But regardless of this, a 10% return, which is upfront, at the chance of a 30% stock dip is a great risk-reward investment to me. So that was the video. I hope you learned about put options. Comment below if you're still confused and have any questions about it, and look forward to this week's video on 3 new stock picks for June.